In today's video, I am going to give you some of my favorite dividend stocks from the United States. Now, as a Canadian, I need to give you some advice if you are Canadian, and that is to put all of your dividend stocks that are American in your RRSP. And the reason for that is because now you don't have to pay US taxes if you do that. So let's get down and let's check out these amazing stocks. So the first one is AbbVie. Now, AbbVie is a fantastic blue chip stock. It currently pays a massive 4.5% dividend, which is actually quite large when it comes to the United States stocks. They don't usually get past that 3.5% to 4% range in most cases, so 4.5% to me is extremely good. When it comes to the average volume, it's 6.5 million shares on average every single day, so it's an extremely easy stock to get in and out of. However, the downfall to it is the beta, which is 0.8, which is a bit below how the market will perform. So if you were to buy something like VOO or SPY and it goes up 1 point, you will then go and only go up by 0.8. However, you are getting a larger dividend, so that kind of evens it out, and you're still increasing your underlying net worth, and you are getting paid to do so. The chart, however, is quite interesting. It's getting up to its all-time high once again. It's had a massive dip there, which no big surprise here. This one is kind of concerning. And of course, it was trading within a range before accelerating. Will it dip back down? It's hard to say. However, what you can do is still collect this dividend. And if the market keeps on going the way it has been, this may be an interesting stock for at least a couple of months at the very least. The one thing I really do enjoy about this stock is, of course, the dividend raises. Check this out, 64 to 71 to 96, and then 96 to 107, and then 107 to 118, and then 118 to 130. This is a great dividend raise company. This is fantastic. This is what you want to see, big dividend raises. And I think that's going to continue considering how well they did in 2020. If they can continue to do in 2021 what they did in 2020, the dividend raises are going to be even bigger. Their quarterly earnings calls have also been really good. They have been exceeding expectations, which is what you want to see with a stock. Now, the next company we're going to talk about is the Coca-Cola Company. Now, there's actually a couple of these on the stock market, and two notable ones is COKE. That's not the one we are talking about. The one we are talking about is KO. That's the Coca-Cola Company. This one trades at on average 14 million shares per day, which is huge, and has a 3.1% dividend. This is the type of dividend that I really like to see from the United States companies. And of course, this one, however, does also trade below the market, which means that if the market goes up by 1 point, this one will only be going up by 0.6. So it's not going to be outperforming the market anytime soon. However, you are still getting a dividend, and it's a solid company that is called an aristocrat company, and it's a very, very solid company. They're starting to get more healthier drinks, which is fantastic. And of course, they still have Coca-Cola, which is still a very addicting substance, even though they got rid of Coke, real Coke, from inside of it many, many years ago. Of course, it's had a very good run until we see the virus come out, and since the virus, it has had a nice run. We're seeing it trade within a range, and now it seems like a very good time to buy. It's off of the recent highs, so we can assume that if this can continue to go the way it has in the recent past, we can see that there may be some more increases coming its way. We can also see that it raises its dividend. It's not a massive dividend raiser, but hey, it still raises its dividend. It gives you essentially a raise every single year, and that's the very minimum that I like from a company. It's beaten quarterly expectations. It's surprisingly not done as well as I thought it would have in 2020. I thought these numbers would have been skyrocketing higher because everyone's at home. because, of course, there's more and more people going out to buy stuff, but maybe it's because people are becoming maybe more health conscious, or maybe because there's not as many people buying drinks at vending machines and restaurants on their way to work. I'm not too sure, but at the same time, it's still doing extremely well. The next company we're going to talk about is Walmart, WMT, and this is an interesting stock pick. Many people are saying that it's going to trade sideways for a while, and it possibly could. It's still going to be paying you a dividend. However, there's less smaller stores right now because so many businesses, in my opinion, have shut down. I've got a lot of friends who have lost their businesses, and who's going to benefit from that? There are a couple of companies, Amazon that doesn't pay a dividend, and Walmart that does, and Target that does. We're not going to talk about Target today, but we're going to be talking about Walmart because they're going to be a massive beneficiary? I don't know. Either way, they're going to benefit from all of these businesses going under. Which is really sad to say. However, they do pay a 1.5% dividend, and their average share volume is almost 8 million shares traded every single day. So it's going to be easy to get in and out of. The one downfall is, of course, whatever the market goes up, Walmart's only going to go up half as much, historically anyways. And it's actually quite interesting. Their chart's done really well until recently. It's had a little bit of a pullback and traded within a range. Depending on how you look at this, it could have been a flag that formed there and it dipped below, which means that there could be some more downside pressure to roughly around 120. Or even 130. It's hard to say. However, at this point in time, if you were to look into buying a company like Walmart, what you could do is to buy in a little bit now and see if it does dip. Now, when you start zooming into this chart, it does look like the flag is forming here, which means that if it dips below this point, it's going to go down. If it goes above this point, it's going to go higher. I do like how they raise dividends, but they're not huge dividend raising of a company. They have done pretty well over the last 4 quarters. They have had one miss, and they've made more revenue last year than they ever have done before, and they did it on similar earnings. So the differential between earnings and revenue is quite scary to me. But at the same time, if you look at this as a 10 to 15 year story, what I really think is going to happen is their earnings are going to go higher, maybe with similar revenue, but their earnings are going to go higher because they're going to be hiring a lot more mechanical things to do what humans used to do. And mechanical things like robots, for example, they just don't have to take lunch breaks. So you can continue to have them work. I'm not saying that that's going to happen. It probably will, however. And again, it's just another sad part of what's happening and what's coming into the future. PepsiCo is another company, and now you're saying, well, how can you support Coke when you also are supporting Pepsi? To me, it just doesn't matter. It tastes the same. But PEP is the company ticker. Dividend is 2.9%. Volume is 5 million shares traded every single day. And its PE ratio is down there in the 20s, and a solid blue chip company in the States will be in that range. When it comes to Pepsi, that's a pretty good range in my opinion anyways. Again, below the beta of 1, which is not going to be performing like the market does, but you're going to be getting a 2.9% dividend anyways. Wouldn't it have been nice to buy it there? However, it tends to trade in a range. It's trading within a range once again. It's at near the higher part of the range, so it's kind of concerning in my opinion. It's hit a triple top, so it may drop back down. So I would really watch this stock before buying it. Right now anyways, but in the future it'll be probably a pretty solid company anyways if you were buying it for future growth and dividends. Now, Pepsi does raise their dividend a lot more than the regular blue chip stock that we see on the US market, 0.8, so 80 cents, up to 92 cents, 95 cents, up to $1.02, up to $1.07 now, so pretty good raises, 4 or 5% or more depending on the year. They have, I'm going to call that a meet, but it's not. They have beaten essentially 4 quarters in a row. Their revenue is on the uptick. Their earnings are on a downtick. If they can fix that issue that they are having when it comes to their earnings being lower year over year, then this could be an even bigger solid company. However, that to me is just a bit concerning. And Caterpillar, which is a video or a stock that I've done a video about recently, If you're wondering what the tick was, I just dropped my pencil. But either way, the Caterpillar stock is going to be very interesting into the future, mainly because of the stimulus, what I'm calling stimulus. It's basically what Biden is doing right now. They're trying to get all of this infrastructure bill going through, all of this infrastructure money, and when that happens, Caterpillar is going to benefit, mainly because of the stuff that they sell. And anytime you need to build roads, guess what stuff you're going to be buying? You're going to be buying those small little bugs called caterpillars, or I should say those big ass trucks that dig things that little kids and myself like to watch dig holes because it's fun. Anyways, let's get down and let's check out this stock. 2% dividend, which is pretty good in my opinion. Volume of 3.5 million shares traded every single day, and the beta is 0.92, which is probably one of the better companies when it comes to meeting the market's increases or even decreases in a way. However, 0.92 is pretty solid in my opinion. Now, when you're looking at the chart, it was trading within a range, but this was through the Trump era, right? So Trump wasn't exactly spending a ton of money on infrastructure. He was doing a good amount, but he was really not spending. He was trying to conserve, trying to pay off debts, I guess. However, Biden comes in, coronavirus goes away, slightly, sort of, in a way, and of course it's growing. Now, the infrastructure bill isn't exactly getting through past quickly enough. That's why it's sort of dipped recently. However, I would take a guess that this is going to go on the uptick. It's still technically in line. If you draw a line, it's still technically in line. That dip was anyways. As long as it doesn't dip below, I would say 205, 200 in that range, or even 210. I would be worried, but I don't think it's going to happen. As long as it keeps on ticking upwards now, we should be all set. Its dividend raises are just make everyone happy, because you're looking at a raise from 86 cents to $1.03. You're looking at almost a quarter of a percent raise, so almost a 25% raise. Let's do some math really quickly. About a 19.76% increase, so that is pretty solid. Beating all 4 quarters recently, lesser revenue, lesser earnings, but again, this was because of a lot of people looking to save money, and of course now the infrastructure bill. This should be a pretty good runner. I hope that this video has given you some ideas as to what to look at to invest. If it has, hit that like button, subscribe. Remember, don't trust any random person on the internet. Do your own research. I hope that you've enjoyed. I'll see you guys in my next video.